Good day, ladies and gentlemen. This is Watson Michael from Ceylon Institute of English and Leadership. And once again, we are honored to have Gabriel Ryan back with us. So, Gabriel, he is actually a vice president for risk management at DBS Group Singapore, right? And he knows a lot of things about risk management. So, Gabriel, welcome back. How are you doing today?
Thank you, Watson, for having me back. I'm doing good. Hope you are doing well as well.
Yep, I'm doing good. The only thing is slightly a bit down under the weather, but yep, all good.
Oh, I
Right.
see. Yeah, I hope you feel much better. Yeah.
Yes, great. So, what is risk management and why is it important?
Oh, this is a very it's a good question and a very broad question. Uh, Let me see how can I best articulate this risk management. It might be easier if we define what is risk first. So, one way we can define risk is an outcome that is adverse, undesirable, and unexpected. So, the key aspect of a risk event is that it is adverse and it is unexpected. So you do not foresee it an adverse event happening, and if it does happen, that is a risk, right? So then the key question comes about is how do we manage an event that can have adverse consequences and may come at an unexpected time, right? So that is what risk management is about. Having strategies to manage unexpected outcomes so that one is able to navigate through those outcomes relatively well and well positioned without suffering too much losses, until one may go down under. Yeah. So I think that's in a very layman's language what risk management is. And sorry, your next question is how do we manage risk? Is that it?
I'll tell you. Okay, so yeah. So now, according to Statista, right, the cybersecurity market is
Right.
projected to reach approximately 202 billion worldwide this year.
Right.
So, and according to the FBI, in 2023, losses connected to cybercrime complaints were 12.5 billion. What are your views on that?
Uh, cyber risk, cyber crimes. This is probably one of the most important risk aspects for most organizations in the last couple of years and between now and moving forward, simply because the world is increasingly becoming more digital. The world is heavily reliant on technology. Businesses, individuals, we are all reliant on technology, and by nature, it exposes us to cyber risk, right? So cyber risk could be phishing, um, for individuals, right? Scams. For companies, it could be similar to ransomware, phishing on a large scale. It could be uh, a cyber attack, like a hacker trying to gain access to confidential data, data leakage along these lines. So cyber risk, cyber crimes. Uh, this is a broad area that is increasingly becoming important in our world today. So I'm not surprised that the losses are increasing, and it likely would be in an upward trajectory as the world becomes, more digitized.
Great. So, thank you for that explanation. Now, can you quantify risks in terms of financial loss, operational disruption, or other KPIs?
Yes, most definitely. So, like I mentioned earlier, right? So the risk um, ambit is really big. It depends uh, what kind of risk are we talking about, which organization are we managing the risk for. So for myself, for example, I'm in banking. So by nature, banking is a risk taking business, right? So what that means is that uh, by being in the banking business, risk is a core topic because we make money by taking risk. For example, giving out loans, right? So you give out loans, the customers pay back in installments and they pay interest. So that interest is an income to the bank. All is well if the customer pays back, but all is not well if the customer, suddenly runs into some financial difficulty and doesn't pay back, right? So that becomes a huge risk for the bank when the size of the loan becomes really big, like corporate loans, right? It could be a few $100 million, and if the customer don't pay back, that's a big boom, lah. Yeah. So from a financial risk point of view, most definitely one can quantify financial risk. Um, Especially within the banking financial institution space. The three most prominent risk: credit risk, which is a risk of a borrower, not paying back money on that the borrower took from the bank, borrowed from the bank. Then there's market risk. Market risk is the risk of adverse market price movements that would lead to a financial loss. So, for example, if you buy a stock, shares from the market, right, and the share price fluctuating from day to day. So that fluctuation is a risk because it can fluctuate in a direction not favorable to you. And for some reason, if you have to sell the stock at a price not favorable, then you incur a loss, right? So that's realized loss. For banks, they book unrealized losses as well. Unrealized movements. So that is a risk to the bank. If one day the price drops 10%, if it increased 10%, it looks good on a day, but next day it could drop 10%, it looks bad, right? So that's excess volatility, which is also a risk. So that's what we call market risk. Volatile movements in market prices, right? And then last but not least, we have operational risk, which are risks that are coming from operational incidences. For example, system disruption, your bank payment apps, suddenly fails, or trade. Bank is engaged in a trade with a counterparty, and suddenly the system crash. Trade becomes haywire. Um, um, Rogue traders, for example, yeah, if there is a stock trader, bond trader, derivatives trader who went rogue, uh, you know, book $1 billion bet that is not sanctioned by the bank, and that bet turns sour, it becomes a loss for the bank, right? So those are the examples of operational risk. Yep. So to your question, can financial risk be quantified? Absolutely, especially for those in the business of taking risk, like a bank or insurance companies, right? Insurance companies also take risk, and for most other organizations, they face risk in one form or another. Um, engineering firms, for example, right? So if there's a engineering firm building a building, an office building, right? There's a risk that workers may get injured, risk that ceiling, may collapse while under construction, all those kind of risk, and all those kind of risk can be quantified and should be managed. Yeah.
Great. So it's a masterclass in a sentence. Okay. So it's some key things which you told Gabriel actually, right? So if you look at the US stock market and the Asian stock markets these days, I mean, it's crazy, right? Certain things,
Yeah,
what's happening.
yeah,
Yeah.
right.
So, depending on the organization's structure, how important is it to have tailored reporting systems for different stakeholders, such as the board, employees, and investors?
Okay. Good question. Specifically within the banking context, the by regulation, the board is ultimately responsible for the risk activities in the bank. So the risk reporting all the way to the board is extremely, how do I put it? The value chain is quite long, lah, right? So it goes through various working committees, it goes through executive committees, and then eventually it gets reported to the board. And the board is also responsible for approving what we call risk appetite, which is a statement of what are the risk bounds that the organization can operate within. So risk appetite, for example, how much credit risk a bank is willing or allowed to take as approved by the board, right? Yeah, so that sets a risk tone, top down, all the way from the board level. Then that is from the get go, and then on a ongoing basis, day-to-day activities, it takes place, carries on, and then at the end of every month, the risk monitoring gets reported back to the board. Okay, where are we? Are we breaching any limits, for example? Yep. So yep, board, the um, risk reporting gets escalated right to the very top, and it is important to have that kind of risk reporting capabilities built, especially within regulated space like banks, insurance companies. Yeah.
Great. So now there are some fake emails and WhatsApp messages which sometimes come, and suspicious links are sent too, often camouflaged. How can we save ourselves from this? Because we need to save ourselves, right? Because some messages, I mean, it's really creepy, right? I mean, with plus one from even from the US, we see that here it's
Yeah.
happening. And I was some time back, I got a call. They said we are from some investment company. We're calling from Singapore. But when I looked at the phone, the code is it's a Japanese code,
Right.
right? So
Yeah, I think this kind of um, cyber related risk is very real, and it especially impacts um, like either uh, the older generation who might not be so savvy, or those that are really young, I suppose, right? But in terms of how do we overcome, there's not too many quick wins or shortcut. It has to be awareness, education, that ultimately the tools to combat this kind of crimes and risk, both by the government, the organization, working organization, even us personally, family members, friends, right? To keep reminding our friends and families to watch out. And I guess last but not least, if anything that sounds too good to be true, it almost certainly is lah. It's like a good old tale that has served well all this while, and it still continues to serve well. One investment scams, for example. I guess for myself, being in the financial services, I do keep up with, say, what are the most performing funds, or the hedge funds, and even the best performing funds by the brightest minds, fund managers. They probably generate roughly 30-40% return per year, right? On average, over 30 years. So that's really good, right? On average for 30 years. That means 40% per year, 2 years is almost 100%. You double up your investment within 2 years, and this is already the top percentile, right? You talk to most funds, you buy mutual funds, insurance funds, the returns are like 5%, 6%. So if 40%, you're talking about superstar level kind of investment returns. And if you get a call from someone promising to double your investment in 30 days, you know, uh, either it's very hard to believe that someone is better than the top performing fund manager, right? You should ask yourself that question. Yeah, how can they generate that return? What are their investment tools? And you will start to realize that if you are that good, you will be in the top firms, like you won't be soliciting via WhatsApp or or emails. So that's sort of kind of awareness that one can have, especially for investment scams. Quite common. Yeah.
Very, very true. Yeah, I mean, certain things are quite suspicious, right?
Yeah,
Okay.
that's right.
So, what are some risk mitigation strategies?
Risk mitigation strategies. This is a really broad question, but I suppose on a very high level, the kind of risk strategies that you can take is risk reduction, risk avoidance, or risk acceptance. These are the three broad categories, right? So this is extremely high level, but more granular strategies would depend on the type of risk that we're talking about. So if you're talking about credit risk, for example, maybe take a step back. Before we can even talk about risk mitigation strategies, we need something called risk quantification. You need to quantify your risk first before talking about mitigation strategies, because you need to know how big your problem is, right? What is the potential size of your problem? And if the size is very big, your strategies might be different, right? So if take, for example, credit risk. If a bank is facing a scenario where it is looking to approve a loan to a customer, right? So how does it decide whether or not to approve, right? So that's a risk strategy. So uh, like I mentioned earlier, you need the risk quantification. So you need to know how risky the borrower is in the first place. So that's quantification. That is achieved through what we call a credit scoring, right? So we have credit scoring models. So it's a statistical model which tells us how risky a borrower is. High score usually means that the borrower is good. Low scores indicate the borrowers might have um, future difficulties in repaying back the loan. So your risk strategy might be, if the borrower is below a certain score, the approach is risk avoidance. Reject the loan. Don't give the loan in the first place, right? And if the score is okay but not very good, your risk strategy might be to ask for a guarantor, right? You want the loan, I can give you the loan, but I need you to have a guarantor. If you cannot pay back, I will chase your guarantor, right? So you can see how risk strategy here that depends on the exposure, which depends on your risk quantification methods lah. Yeah, and your risk appetite. Yeah, risk appetite, like your lowest score, you said, okay, I don't want at all. So that's my risk appetite. I cannot tolerate losses, expected losses beyond a certain score, right?
Yeah, because sometimes even you find like people like certain startups and certain companies, they go to ask big loans, but
Yeah,
apparently
yeah.
they don't even have a basic business plan.
Correct. So I think that's the reason why for startups is the funding strategy is not to go to a bank to ask for loans, but rather to go to like a venture capitalist, private equity, to pitch the business plan and get them to invest in the startups.
Yeah, very true. I can't remember this company's name, right? But actually, I wrote about it some time back on LinkedIn. Two brothers, they went from New Zealand, they went to China. They didn't know the language as well. I think they took a loan about 10,000 New Zealand dollars that time. Now, if I'm not mistaken, it's $1 million, $1 billion business. Uh, can't remember the name, right? But
Right.
they did pretty well in China, actually.
Okay. Yeah, that's good.
Yeah. So, now based on everything, right? And we would like a final message from you, Gabriel, to our viewers and listeners, whether it's about motivation or follow your dreams, whatever. And the interesting thing is, I remember seeing a post of yours last week or the week before. You even didn't know that you on a particular channel, right, as a top contributor for something because
Oh,
you.
yeah, that's right. Yeah.
Yeah, right. I can't remember what was that, but there was something that uh, uh, you got a lot of views for that and all.
Yeah, yeah. I think that was about because I'm not a marketer. Um, I I don't sell things online, including the LinkedIn, right? So I don't really track this kind of metrics like engagement metric. How well my post does. Although some of them does quite well, some of them don't do well.
Very
But
well, most of it.
so apparently there's one site that does this tracking, and I happen to be on the list, just so happened by sheer luck, I guess.
Yeah, but some interesting posts, interesting posts. Okay,
Yeah,
a lot of interesting posts I see. Okay, I have a good laugh at it sometimes. Okay, so yeah. So any final message from you for those who seek motivation or to follow their dreams?
yeah, I would say don't be limited. Always um, always be curious, and in the risk space, uh, I would say for me personally, it has been quite rewarding. Yeah. So if there is anyone that has aspirations to be in the risk space, please follow that.
Great. So, Gabriel, thank you very much for taking time and doing this podcast with us.
Thank you so much, Watson. Thanks for having me.
It's an honor.